start from the beginning, so hopefully you can hear us. We introduced ourselves. Fernando Chavez. I'm a tax senior here at Abbott, Stringham& Lynch. I've been in the accounting field for about 20 years and have experience in various industries. I have a passion for helping startups and helping a lot of people kind of navigate through the kind of the early stages, and because what ends up happening is you're so enthralled with the idea of your startup and being able to start a new venture. I'm really excited about that. And then they find about a lot of the compliance that has to happen. So whether it be with everything as far as getting the business permit in the city that you're doing business in, to income tax filings at the state level, and possibly if you have employees in another state, there's multiple state filing, or if there's international filing requirements. If you've got maybe possibly some bank accounts that were in a foreign country, you have international filing requirements. Sometimes you have to understand the treaties between different countries and what happens there. Ownership structure. It's not uncommon to have foreign investors, and there's foreign ownership filing that has to be required. So a lot of it is like brand new. If it's someone who's just kind of grown up out of school and they get their first job at working at In-N-Out or whatever the case may be, getting a start job, you're not really exposed to a lot of that kind of those type of events. But sorry, I didn't mean to hog the stage here. But I want to introduce my partner, Christy Kempsky.
Okay, thanks, Fernando. So I'm Christy Kempsky, and I am an accounting consultant here at Abbott, Stringham & Lynch, or ASL, as we refer to ourselves. And I'm sort of a traditional number cruncher. So I do bookkeeping, financials, accounting, and a lot of the compliance filings that we're going to be talking about today. Before we move on, I just want to cover a couple quick housekeeping logistical items about the webinar today. We will answer questions at the end of our presentation, so feel free to add those as they come up for you, and then we'll take a look and answer those at the end. We are recording today's webinar, and we will post it on ASL's YouTube channel in case you need to step away and we're able to attend them for the whole hour that we're here. And we would appreciate your completing the survey that will come up at the end of the webinar. Let us know how we did and maybe what your takeaways were, and we'd love to hear about what other topics you might want to hear about in the future if we do future webinars. So I'll pass it back to Fernando.
Sure. And so I had this chart up, and it's basically to kind of show the life cycle of a startup. And, you're starting you're thinking about it. Maybe you get together with a couple friends or partners, and you get together and you form your entity, and then you're trying to, maybe get some employees. You start, growing, and you start developing a revenue stream. You need some investors, and so you get a round of funding, and then you're in that growth stage, and then now you start upgrading. Maybe you need some more managers to kind of manage the day-to-day while you're kind of out there, and you're in that mature stage, and then you're transitioning, maybe possibly acquiring another company or acquiring someone's intellectual property in a sense, to maybe take your company to the next level and ultimately maybe end up going public. And at each of these stages, our firm can help you at each of these stages. On our website, aslcpa.com, you'll be able to click on this. It's an interactive map, and you can see all the various types of services at each stage.
So those pluses, if we
right.
click on those. And we're really talking today about the emerging businesses. So the early stage startup and the growth stage is the group that we tend to serve in the emerging business group.
That's right. That's right. And so just to give you an example of what type of services we provide, so in that early stage, we're talking about what should I be? Should I be a corporation? Should I be an LLC? Should I be an S Corp? What if we just want to stay as a partnership? We don't want an LLC. There's all different types of reasons to do one or the other. We'll ask, what's the end game? Do you plan to go public? What is it? What's the plan?
Yeah.
Maybe what type of accounting system should I use?
And hopefully you use one.
right, yeah. I do not want to hear that you're tracking all your expenses on Excel. We want to make sure that you want to have separate books from your personal and business. We want to make sure the business is reporting its activity, because based on those books is where your investors are going to start looking at and see if you're a viable entity for them to invest in. Mm-hmm. We have temporary CFO services. We have business and income tax compliance, international, state, and local tax consulting. That may mean in terms of maybe some sales tax. Maybe you're selling software or hardware, And it gets very tricky when you start talking about, well, what is it you're selling? Are you selling a subscription as a service? Are you selling, are you delivering it on physical media? There's all kinds of rules that go along with sales tax. That's a big one. Then we have maybe estate and gift tax planning, and our valuation group has lots of various types of services. A 409A valuation, which we'll talk about in further detail later in this conversation, and talking about Form 3921 and exercising incentive stock options. That will be something we'll talk about as well. And so to start off, let's see, it's December 13th. We have 18 days left until 2018. I'm excited personally about my 2-day countdown till Star Wars on Friday. That's kind of where my head's at. But and then we've had Christmas after that, so the year's just going to go by really quick. So even though we have 18 days, it's actually going to feel a little bit less because we got some holidays sprinkled in there.
Yeah.
And so what can we be doing right now? What should we, Christy, tell us, what should we be doing right now?
Okay, well, we're going to talk about my favorite thing, which is cleaning up the books. And before we talk about the how, let's talk about the why. Why is that important? Investors and you yourself, management, make decisions based on your financials. And we want you to make informed decisions. You want to know accurately where your business is. So that's one of the reasons it's important. There are a lot of upcoming deadlines starting in January that we're going to be talking about today, and those rely on this year's 2017 activity. So we want to make sure that it's all input and cleaned up and ready to go so that we can meet all these filing requirements that we have coming up. And you can be proactive before the year is over. If you know where you are right now, there's still time to make some proactive decisions that could positively affect your business. So those are the reasons why. Let's talk about the how. We want to make sure that all the activity is captured in your accounting software. So the first thing that I start with is the bank and credit card activity. Make sure that it's all input, whether you download that or input it manually. And by now you should have received your November bank and credit card statements depending on when they cut off. So you should be able to, once all that activity is in, make sure you've reconciled all those accounts through November. And then what you can do is a bank reconciliation is actually a tool, an accounting tool you can use to clean up your books. What you can do is review the detail part of your reconciliation and scroll down to the uncleared section. And you could see potentially uncleared deposits might be there, and you'll definitely see, I think, some uncleared checks or outstanding checks. And what you want to do with that is if your activity's already been tied out to the bank and you still have a deposit on the books that's unclear, that probably doesn't belong there, that needs to be adjusted off. And again, with the outstanding checks, if it's a couple months old, that's not unusual. Your vendor may not have cashed it. But if there's something from the beginning of the year or a prior year that is potentially stale, if it's in the current year, you can go ahead and void that stale deposit or stale check. If it's in a prior year, you don't want to void it because that's going to change the activity from that prior year. There is a way to adjust it off, and please, talk to Fernando or I about how to do that, because we want your books to tie to your tax return from the prior year. If you void a prior year check, you're going to throw your activity off from that year. Just a quick note about payroll checks. Because that information has already been reported on either your payroll tax filings or that person's W-2, talk to your payroll provider, and we hope you have one of those as well, about how to do a workaround with that to make sure if you need to reissue that check or void it, how that's going to affect the reporting that you've already done. So once you've got all that bank and credit card activity in, then you need to account for things that may be expenses of the business that aren't on the statements, and that would be accounting for unreimbursed expenses that you paid personally. So perhaps there was a tax estimate due and the checking account was a little low, so you paid that personally. We want to make sure that's captured because that was a business expense that we won't know about because you paid it personally. And conversely, we need to account for any personal expenses that were paid by the entity. Perhaps you were at Home Depot one day and you forgot your personal credit card and used the corporate one. So you want to make sure you account that off so that the information that is in your accounting software is just that belongs to the entity itself.
And the other thing about personal expenses that were paid by the business, be careful with that, because once you have commingling of funds, you could potentially you may lose your corporate veil, so to speak. So you may kind of lose some of that corporate status. So you can get some legal protection, but if you're commingling funds, then you kind of lose a little bit of that protection of being a corp.
Yeah, it's good to have good boundaries, set up separate accounts, separate books, and not mingle those as Fernando just mentioned. So that's on the checking and credit card. Now on the other side, make sure that you have invoiced all the revenue and input all the bills that you have from your vendors or vendors that, if you know that that's coming. And once you've done that, there's some other accounting tools, reports in your accounting software that you can use. The first one is an AR aging report. So I would run a summary report, and what that will show you is on the left side, it'll show you your customers, and then there'll be columns that show how old that accounts receivable is. And you want to take a look at that and specifically review any large or unusual amounts, and definitely everything in the over 90-day column that's there. Why haven't you received that money for 3 months or so? Is there some sort of a conflict where the customer doesn't feel that they've received everything they were supposed to? Or potentially does your customer have a cash flow issue and is not going to be able to pay that? If so, this is the time to, think about that collection or potentially write off that accounts receivable if it's not going to be collectible. On the plus side, or on the AP side, you're also going to have the same report that you can run. That's a summary AP aging report. Again, you're going to have your vendors along the left side, and then you're going to have those columns that show how old your accounts payable is. And again, you're going to want to take a look at any larger unusual amounts and everything in that over 90-day column and determine why haven't you paid your vendor. Again, maybe you don't feel that you've received all the goods or services that you were entitled to, so you'll want to work that out with your vendor and just make sure that that all gets cleaned up from your AR and AP standpoint.
Yeah, and I see it's a common error that someone will enter a bill and then they pay it with a check and it's expense, and then the bill's still sitting in there. So you have a double expense, and so you're kind of over-reporting your expense. And there's tax consequences in the sense that if you're an accrual basis taxpayer, if you have more invoices in there, and you're going to get taxed on invoices, not necessarily what you collect.
Correct.
So if you have a duplicate invoice or you have something that you don't feel you're going to collect at the end of the year, and if you don't want to be kind of taxed on it, as an accrual basis taxpayer, I'm just saying that, then you'll be able to, if you write that off before the year end, then it doesn't have to be captured, so to speak. And then the same thing for the AP. If you have any expenses that you want to capture in 2017 that you're going to that relates to, say, December. If you're accrual-based taxpayer, if there's a December, but it's not necessarily paid, but it'll be paid within 2.5 months after the year, then you will be able to get that deduction. So that's why looking at your AP and AR, there's a tax consequence if you're an accrual-basis taxpayer.
Yep, good point. Thank you. So let's talk a little bit about some other parts of the accounting that we can review. If you do have inventory and in your company, it's a good time of year to confirm receipt or shipment of any goods before year-end, and then do a physical count at year-end if you're a calendar year-end company. And another thing I'd like to talk about is fixed assets. So it's good to have a capitalization policy. What that means is what dollar threshold are you going to create an asset that you're going to put on your balance sheet versus take something as an expense. And I know the tax regs let you go up to about $2,500 in order to capitalize something, but there's reasons that you might want to use a lower threshold. I know we're going to be talking about one of the county filings that we do, the personal property tax filing, and I know they won't state what their threshold is, but our experience from working with them is their threshold is about $500. So if you're subject to that reporting, you're going to have to really track everything over $500. So it's a good idea to determine what your filing requirements are and then determine what's a good capitalization policy. One of the things, once you've determined your capitalization policy, that you can do to make sure that everything did get captured is to review some common expenses that might have a fixed asset in there that was expense. So review, say, your computer and internet expenses. Maybe there's a $5,000 server that got put into expense that really belongs on the balance sheet. Repairs and maintenance is another one that I sometimes find fixed assets in. When you're reviewing it, you might see there was an HVAC system in there for $6,000. That really belongs on the balance sheet. So that's one of the things you can do to clean up your fixed assets. So, you know, once you've got this deep dive done on your accounting and you've taken yourself through November at reviewing all that detail, then you're in really good shape. When you get those December statements in early January, you only have to put in that 1 month of activity and get that reconciled. You've done your deep dive, and now you've got the information that you need for these upcoming compliance filings that we're going to be talking about. So let's talk about the upcoming deadlines that we have in January. There's a lot of them in January. First, there's the payroll tax filings, and you'll have your quarterly filings, which are your 941, your DE9, your DE9C. Those are California. And if you have other states, then you'll have other forms if applicable. Then you've got your annual filings, which is your 940, and W-2s for your employees, and W-3, which is a summary reporting page. So again, this is all this reporting is based on that 2017 activity, and you can see there's a lot of deadlines in January, so that's a good reason to be proactive and have it all done so you can get through all these deadlines. Sales tax filings are also due if your calendar year in January 31st, and then we're going to be talking a little bit more in depth about the 1099s and the forms 39, 21, and 22. So there's actually a couple different kinds of forms 1099. We're going to talk about the 1099 miscellaneous, which is the most common one. But I just want to mention real quick, there's one for if you have paid dividends that year, there's a 1099 DIV or dividend. And another one that might be applicable for you is a 1099 INT for interest. That is if you have one of those family and friend loans and you've been paying somebody interest, then that should be reported on a 1099 INT. But let's talk about the 1099 miscellaneous a little bit and what you need too. And we're going to go back to being proactive about getting the information that you need to file. So we've talked about getting the accounting information because you need to report the dollars that you paid to those vendors. But this is the information that you're going to need to capture in order to prepare the filing. You're going to need to have your service vendors fill out this W-9 form for you. And actually it's all important here. I should have put a big red box around the whole thing. But I want to point out a couple of things on here. If you are going to have to furnish a 1099 to somebody, there is an exemption if that person is a corp or S corp, or if that entity is a corp or S corp, with one exception that we'll talk about later. So it's really important that your vendor fill this portion out so that you know whether you're going to need to furnish them a 1099. If they're a corp or S corp, then it's not going to be required. I just want to point out above that for the name, if you are a sole proprietor, say Bob Smith, and you have a DBA of doing business as Bob Smith's Window Washing, we're going to need your actual name in box 1 that ties to the Social Security number that you're using. And then you can put your doing business as there on that line 2. So again, box 3 is very important to know if we're going to need to furnish you a 1099 or not. And then in box 5, 6, and 7, this is a good place where you're going to get the vendor information on addresses. And one thing that's you may have noticed on the uncleared checks is perhaps your vendor has moved and you didn't know that. So it's a good idea to check your vendor invoices here and make sure that you're familiar with all your vendors and that they all are familiar to you. AP can be a area of fraud, so it's good as management to pay attention to the vendors and make sure that you're aware of all the vendors that you're using. So get that vendor information address here, and then the taxpayer ID number, whether they're using their Social Security number or they could have applied for employer ID number. Make sure you've got that and that it's signed and dated. So right now, if you haven't gotten these done, you can do that proactively because you'll need this information to file a 1099. Best practice would be every time you have a new service vendor, I would provide them this W-9 form and have them sign it before you make that first payment to them. They tend to be pretty motivated if they know that their payment is contingent on getting this form to you. Okay, so let's talk about the 1099 miscellaneous. We've talked about getting all the accounting information, and as you can see, there's all the information about the recipient and their ID number here. Most common 1099, the one that we're familiar with, is Box 7, the non-employee compensation. That's where you put your independent contractors. 1099s have been around for a while, and essentially, if you've paid any individual partnership or LLC in excess of $600 that year, you are required to furnish them with the 1099 miscellaneous here. And if you don't furnish that and file those, you're not supposed to take that deduction on your tax return. Now, that's always been true, and we're going to talk about something that's been added to your tax return that has recently put an emphasis on making sure people are filing these. One thing I want to point out on the 1099 miscellaneous that you may not be aware of is box 1 at the top there, it says rents. So if you pay rent to somebody that is not incorporated, you are supposed to report that amount that was paid in rent in box 1 here. Now that's a big chunk of expense for a lot of us here in the Silicon Valley area. So again, in order to take that deduction on your tax return, you should be reporting rent paid to anyone that is not incorporated. Now, lawyers are the exception to the incorporation rule. If you've paid a lawyer over $600 this year, and
Even under.
no, I think it's over. If you've paid a lawyer, you want to put a 1099 out to them, even if they're incorporated. So that's a little known fact. They do not get the corporate exemption. And the penalties for not filing, besides the fact that you're not supposed to take that that deduction on your tax return, range from $50 if you're 1 month late up to $260 per form, depending on how late you are. And then there's a kind of a nasty one called the intentional disregard penalty. That is $530 per form with no maximum. So that means you knew you were supposed to file it, you said you were going to file it, and you didn't file it. There's a fairly steep penalty for that. No limitation. So I just want to point out this piece of, or these line items have recently been added to your tax return. This is a corporate tax return, but you will also find this on a Schedule C on an individual tax return. And as you can see, they ask directly on the tax return, did the corporation make any payments, this says 2016, but 2017, that would require it to file the forms 1099. So that's, if you answer yes here, then you have to answer B. If yes, did or will the corporation file the required forms 1099? So you have to answer this on the tax return, and then when you actually sign your tax return at the bottom, it says under penalty or perjury that all the information stated above is correct. So this is where the 1099s have kind of gotten their teeth recently, because they've recently added this to the tax returns, and people are paying a little more attention to their filing requirements for 1099s. I'm going to turn it over to Fernando to talk about the forms 3921 and briefly about the 3922.
Thank you, Christy. So I'm going to talk about Form 3921, and this is the exercise of incentive stock options, also known as ISOs. And the purpose of this is so you have your employees, they typically exercise their shares and they buy them at a much lower price, and then hopefully within a year or so or even later, when the value of that stock goes up, they can sell them and make a gain. So the idea is that they have a really, really good strike price for them before there's some type of activity, so maybe a round of funding or some other type of event. And so before this gets issued, I just want to point out that there should be a 409A valuation done when these options are granted, because technically you can't grant these options without a 409A valuation. So if that's something, if this is something that maybe you want to consider doing for your employees, feel free to reach out to us. We have an excellent valuation group. Jeff Files leads our valuation group, and he can help lots of clients of ours that need a 409A valuation. We even had a case of they had to go back 2 or 3 years, and they had to kind of retroactively recreate their their 498 valuation, which can be done, but it's not good practice. And then that employee could potentially be missing out of being on the clock. And one of the things that we also want to say is it pays to be compliant, because one of the tax incentive of this is just an information return, just to put things in perspective. It's an information return. This doesn't mean I owe X number of tax by reporting this form. No, all it does is it puts you on the clock with the IRS, because most of, say, a startup is not public, not publicly traded, and they're not submitting any forms to the government in that regard. It puts you on the clock and saying, on this date, I exercised my option, and so now the clock starts. And so the idea is that once you've held on to the stock for over a year, so say I buy the stock January 1 of 2017, it's January 1, 2018 now. If I want to turn around and sell that stock, if there's a gain there, then I would get what's a long-term capital gain treatment, which is 15%, or if you're in a higher income bracket, it's at 20%, versus the individual rate. So if you don't file this and say you buy it and then you turn around and sell it immediately, then it's just considered ordinary income. So there's no tax incentive or tax benefit. So a lot of times they will buy this and then they wait until there's some type of liquidity event, or there's some type of funding event, and that's what kind of triggers them, like, oh, I'm going to buy it because we know we're going to get bought out, or something like that happens. And then they missed out on, like, if they had held it to a year, they would have gotten that huge gain at a much lower tax rate than doing it right before. So that's one thing. So we want to get the clock started on that to get the benefit of that long-term capital gain treatment. I want to also point out that so date one, box one, you have the date that's granted, so you need that 498 valuation done. The 498 valuation should be done on an annual basis, or at least when you get one done, it's good for a year. I should put that, and then it's usually done on an annual basis. A lot of people ask, oh, I need to file this form. What's my fair market value? And they go, what goes in this box for? And we say, no, I can't tell you that. That has to come from the valuation. And then it goes back to our conversation about, well, you need to get this done in order to be able to fill this form out correctly. A lot of times attorneys or whoever's tracking your cap table are the ones who prepare it, but please reach out to them and ask them if they're going to confirm with them that they're going to file that form. Don't just assume they are. So just because they're tracking your cap table and someone exercises their ISOs doesn't mean that they will necessarily file this form. Or if you have a plan administrator of some sort who's keeping track of your stock, that needs to be just confirm with them. Or if there's a fee, sometimes some people will get discouraged by doing it. But again, there's definitely benefits to just be compliant.
Yeah.
I'm also going to bring up, right now, I want to talk about international tax issues, because we talked about, oh, what if I have an independent contractor, and we looked at that box and say, oh, okay, well, they're an individual, they're not a corp, they're not exempt from it, but they live out of the country. Do I need to issue a 1099 to a non-U.S. citizen? The answer is no, but there are potentially some other tax issues that may come up. So if you have a foreign contractor, say maybe you have engineers in India or whatever the case may be, then they don't necessarily have a withholding, or I'm sorry, they don't have a 1099 reporting requirement, but there may be some withholding that needs to be paid on those, essentially kind of like wages. It depends if that person, the foreign contractor, is filing a tax return in the U.S., because it's U.S. sourced. And then you may not know all the tax treaties. And so again, that's an opportunity to reach out to your accountant, your CPA, and say, I have a contractor, and looking up the treaty rules and understand what needs to be done there. What is the treaty between the two countries? And until you understand that, then you'll know how to go proceed. So there's no blanket answer. I can't just say, well, do I need to withhold, a contractor who works in Canada? I mean, without knowing all the treaty rules off the top of my head, I can't answer that question. And so the withholding requirement would be like withholding 30% essentially of that check that you would send out. You hold it here as for the U.S. that you would submit to the government, and then that contractor would file in the U.S., and then they would have to determine whether they get a refund of that withholding that you would submit to the government. So how do you know? So instead of a W-9, there is another form they fill out. It's called a W-8-BEN, business entity number. So that's a form that they could fill out. So if you have them fill out, that will help you kind of determine what needs to be done there on the withholding side. because the IRS will kind of hold the company accountable for that withholding. So even if you didn't withhold it, they'll say, well, you still owe it. And I've seen that happen. If you're doing international business and you have a foreign bank account, there is a form you file every year, and it's the foreign bank account reporting form. It's with FinCEN 114, I believe, off the top of my head.
The F-bar.
The F-bar, yeah, it's known as the F-bar, and the penalties for not filing it is $10,000. It's not a penalty they take lightly, and rarely is it ever waived. It's something that is very enforceable, and if we've seen clients who, oh no, we didn't report this, and maybe it was for the last, say, 2 or 3 years.
You have a client in Canada that had like only $500 in the bank account.
Yeah, well, not even that much money. Yeah, it was $500, but the fact that they had that account there for 3 years because they thought they were going to expand in Canada, and then what ended up happening is, well, you need to report that foreign bank account, and since they missed out for the 3 years, it was $10,000 times 3, so $30,000 of penalties for not reporting it. They do have some type of program where you can kind of come forward and say, my fault, mea culpa.
Amnesty.
Yeah, a little bit of an amnesty, and just say, I'm coming forward. There's a program, and if you were concerned that there's some exposure, which again, exposure, there's that word again that scares investors away. You don't want to scare them away. You want to get compliant and be in the good graces of the government and your reporting. Let's talk about some other deadlines that are coming up. So we talked everything about that's got to happen in January, your 1099s, your payroll tax filings, so all of that. And then just after that, you'll have, if you're in the city of San Francisco, there is a San Francisco gross receipts and payroll tax. And it's something that got implemented in 2014. And they had, essentially, it was all payroll tax.
Yeah.
Honestly, it was 1.5% and no gross receipts tax. Then the following year, it got phased out to 1.35%, and then they introduced the gross receipts tax. And then in the years that come, payroll tax will gradually decrease with an increase in the gross receipts. So again, it goes back to, you need to know what were your 2017 numbers, what did you pay, who worked in the city of San Francisco, who did services for you there, or revenue of customers that you have in San Francisco. That all has to get accounted for. Then there is an extension, but it only gives you 60 days. So it's not like a traditional extension where it's like 6 months.
Yeah, and you have to do the calculation anyway to determine what you're going to owe, because you're going to have to pay in your estimate of 90%, even if you go on an extension.
Yes, and that's true even with your regular corporate or LLC, whatever income tax filing, whatever tax that you owe is due at that filing deadline. And when you get an extension, it extends the date to file the return, but not to pay.
Yeah.
So whatever
That's
you
a common misunderstanding.
Yeah, it doesn't extend the clock in terms of what you have to pay. We will talk about one type of deduction that will allow you to pay something by the extension date, and we'll get into that once we talk about tax planning. Other deadlines. So if you're a Delaware corp, very common. So it's one of the most common corporations we see out there. There is a March 1st deadline. So even before the S corps, which are due in March 15th, or a C corp like in April 15th, in March 1st you have another deadline, and this is not based on revenue. It's not based on income. It's simply based on your equity structure, how many shares and the par value of that stock. So for the Delaware corps, March 1st, you circle that in your calendar and make sure that it gets filed. There is a $350 minimum. That's for 2017. And just a note, in 2018, that goes up to $400. Some people, when they come
for the minimum,
yeah,
right?
yeah, for the minimum, and that's typically what it is. And in there was something else I mentioned there about the minimum of the $400. If you're a corp, so you're Delaware corp, and then you're doing business in California, there's that $350 or $400 next year that's owed, and then in addition to that, you have your $800 minimum franchise tax that's due as well. So understand that when you're a Delaware corp, you still have those two tax filings, even though you're not physically in Delaware.
Gotcha.
And then March 15th, if you're a partnership, S corp or LLC, essentially a pass-through. So we'll talk about where all of the earnings of that entity go straight through to the owners. So in partnerships, those individuals or the S corps flow through to those individuals, and then that gets reported on their income tax filing due April 15th. Now this is different from years past because it used to be where the partnerships used to be due on April 15th. But then what ended up happening is a lot of individuals that were waiting on the K-1s from those partnerships couldn't file their income tax returns on time. And so almost everyone went on extension, and then they didn't know where they stood until later in the year. And so this was kind of one way of kind of alleviating that and kind of accelerating everyone getting their K-1s earlier so they could have more people file on time by April 15th with their information without having to go on extension. Then on April 15th, you've got your C Corps and and the individuals, all of us, so Christy and our tax returns are due April 15th, and single member LLCs, they're owned by an individual. And single member LLCs, there is a little bit of a gray area in terms of when they're due, because if a single member LLC is owned by, say, an S Corp, then the due date is March 15th. So I would just kind of say that single member LLCs, it's not always April 15th, unless it's owned by an individual or something that is due on an April 15th deadline.
Got it. Follows the entity.
Right. And then a single member LLC can be husband and wife, so you're allowed to be a single member if it's just husband and wife. So even though there's two people, it's not a partnership in that regard. So it could be considered a single member LLC. And then the last one is the business property tax, Form 571L. The form itself says it's due April 1st, I want to say, but it's delinquent if not received by May 7th. So it's essentially a May 7th deadline.
Yeah, and it's a grace period. You don't have to file an extension for that. It's just automatic. And the filing requirements on that is that if you have $100,000 of assets in your business, not including vehicles, but this is your business assets, your furniture, computers, servers, leasehold improvements, then you are required to file. It's also possible that you receive a notice from the county. Those come out in January, and if you receive a notice from the county, even if you don't have $100,000 of assets, you're also required to file. And we kind of have heard that the county sends people out, boots on the ground, and writes down business addresses, new businesses, and that's how they often find you and then send you that filing notice. So again, $100,000 of fixed assets, even if you don't get the notice, you've got to file that. And then if you receive the notice, even if you don't have $100,000, you still have to file.
Right. Excellent. So let's talk about the most common penalty that we see. So we've talked about things that you can do to avoid penalties. So whether it be filing the 571L because you find out there's a filing requirement, or there's the number one. So I'm just going to say that Geico is not the only company where 15 minutes can save you money. We're going to save you some money right now by making sure you do this one thing that's very easy. It doesn't, if you're a corporation in California, it doesn't cost you more than $25, and if you're an LLC, it doesn't cost you more than $20. And that form is the Secretary of State's Statement of Information Penalty. This is literally a form. You say the entity, the address, who are the officers. That's pretty much it. That's all.
For California.
This is for California. And if you don't file it, that $20 or $25, depending on which entity you are, then you are automatically issued this $250 failure to file penalty. And this is a penalty that rarely, if ever, gets abated. It doesn't go away. So you could either pay the $20 or the $25, whatever the fee is, and then avoid this $250 penalty. And a lot of times is people were waiting for like a postcard that comes in the mail. So if you're a corporation, you'll get this little postcard in the mail that says you have a statement of information, and they give you a little link of a website. And both of these can be done online. It's very easy. If you go to the Secretary of State website, you can even type in your corp name or LLC name, and it'll tell you when you incorporated, because that matters, because based on when you incorporate is when this is due. So it's due, you can file it up to 5 months before your incorporation date, and then it's due by that month. So for example, if I'm a January corporation, like we incorporated in January, then I can file it as early as August of the previous year. So from August, I could file it at any time, and then it's good, and then I renew it again that following year.
So it's a generous filing period.
It's a generous filing period. But once you're in February and you say, oops, I forgot to file it, and again, every company is different, so it really just comes down to when you incorporated or registered with the state of California. So if you can just go to the website, look at it right now, and you can see your date, and you'll know when that's due, and avoid this $250 penalty.
Put it on the calendar.
Put it on the calendar. So now, a tax planning strategy. Let's start going into, okay, what can we do? We talked about you cleaned your books, you've gotten all the information you need to file your information returns with your 1099s. We filed any 3921, so people get the tax advantage of being able to be on the clock to get that long-term cap gain treatment. We've talked briefly about all the compliance stuff. Okay, and now what can we do about our bottom line? So we said know your estimated taxable income. So what's your bottom line? What are you going to pay tax on? So if you're a corporation, you have income, then this is essentially, if you're a personal service corporation, it's automatically going to be a 35%. As a corporate level, it's tiered. It's depending on how much income you have is what tax you pay. And if it's a pass-through, it's whatever your individual rate is, your percentage of that income. That's the way we want to calculate it. I will kind of briefly talk about what's going on right now with the House and Senate and the tax bill that they're proposing and how kind of the overall rates are going to go down. So all of the advice and recommendations that we're talking about right now would still apply, regardless of whatever the rates are. These tax strategies of accelerating expenses and deferring income still apply, and that's especially for cash basis taxpayers. So if you're a cash basis taxpayer, meaning the money that you receive from your receivables is what you pay taxes on, and then you only get to account for deductions that you actually pay, or you write those checks.
In the current year, okay.
Yes, in the current year that you actually pay out. Those you get deductions for. So sometimes as a cash basis taxpayer, you can accelerate property taxes. Like you can pay the first installment and the second installment. We'll pay them both now without getting into the tax reform of how the state and local tax deduction kind of goes away. We're not going to get into that, but still, you would still have the benefit right now to prepay that. Same with maybe you can prepay a couple months rent, and then, or if you have, let's say your 6-month insurance policy is up for renewal, to go ahead and prepay that, and you will be able to get deduction. And this is specifically for cash basis taxpayers.
Which I think many of our emerging businesses are generally cash basis, right?
Right. And then if they're service based, they are allowed to use cash basis.
Okay.
And then if you have, this would be a great time of year to purchase some fixed assets. Christy talked about how the capitalization policy, if we're talking about something you buy over $2,500, maybe there's a new 3D printing machine that you're going to use or some other type of manufacturing equipment that you need. You can put that and place in service. So it's not just buying it, it's you're buying it and placing it in service before the year end. And there are a couple pretty generous tax depreciation rules. So if you want bonus depreciation, which means you are allowed to take 50%. So if I buy a $5,000 piece of equipment, I automatically would be able to get that $2,500 federal deduction, even though I place it at the end of the year. And if you wanted to expense the whole thing under Section 179, you could. You have a large expensing policy for federal, but there's a big difference between federal and state. So I won't go into the whole minutia of how depreciation is calculated, but just know that if you were to, for example, buy a $12,000 piece of equipment in January, and you're saying it's a straight line depreciation, and it's over, for the year, you would get that $1,000 depreciation every single month. If you had bought it at the end of the year, you would just get that 1 month. But with 179, that's where you can kind of accelerate some of this depreciation deduction. And so a lot of times what happens is people will not necessarily pay for it, but they'll secure a loan or a note on it. And so sometimes when you buy that $10,000 piece of equipment, I'm not saying you have to come up with the $10,000 of cash to pay for it.
But it has to be placed in service.
Placed in service, and then you can have a note or a secure note that's basically allows you to take that deduction.
Does it matter if it's new, used?
It does. So it matters if it's new to get bonus.
Oh, okay.
So if you want bonus depreciation, you need it to be new. 179, Section 179 does allow you for used property. However, you can't use 179 to generate a loss. You can't put yourself into a loss situation with 179, whereas you're still allowed to use bonus. So that's where some of the little minutia kind of comes into play. And then the next big item is a retirement plan. If you're an LLC, you have the ability to have a plan in place. It's just the plan. You just get if you're an LLC, you can get a SEP IRA, get that in place. If you are a corp, maybe you want a profit sharing plan or something else. of that nature, to get that plan in place, written and in place, and then it doesn't have to be funded until you file your tax return.
Ah, so this is your one exception.
Yes, so this was the exception to the rule. And even if you're a cash basis taxpayer, you just need to have the plan in place. And I had a client this last year had a $360,000 profit sharing plan, and it went to all the employees, but they didn't have to fund it, not only until when they filed their tax return, but until the extended due date. So they had until September of the following year to fund this $360,000. So they got the benefit of the deduction, but didn't have to fund it till many years down the road.
And
with,
cash basis.
and they were cash basis. And what's great about it is because they were a seasonal type of business,
Mhm.
so a lot of the cash kind of comes in a lot in the summer.
Got it.
And so in those summer months, that's where they were to fund it. And so they basically got the benefit of the deduction by the time that they filed, and then they funded it by when they filed their return. The other important thing about being on time and getting things filed without having to extend is for startups, there is an R&D payroll tax credit. Well, there's an R&D credit, so if you have taxable income, it goes against that income first. But if you're, say, a loss corporation or a loss company, and you want to claim this R&D credit for U.S. payroll wages, so you are allowed to get a little bit of a payroll credit, and you can apply that towards your 941. So that's a real cash savings, and you can't claim that credit until the month after you file your income tax return. So if there's even if it's a C corp and they file a little early in March, they'll be able to use that payroll credit, assuming that they're a loss, on their second quarter payroll tax filing.
And that's a real cash savings.
And that's real cash savings. I had a client last year who filed in March, and they were able to get a $60,000 payroll tax credit. There was a little limitation on that, but they still had a $30,000+ payroll tax credit, and they got that as a huge refund check on their second quarter payroll tax return, and then they used the rest of it the following quarter after that. And if you have employees in other states, again, just remember that there's probably an income tax filing in that. So let your accountant and let your CPA know, hey, we've got this new employee in this other state. There could be potential other filing requirements.
And that's also, I guess every state has a different nexus requirement, right?
Yes.
It could be people, it could be
Property.
income or property. Yeah.
Yeah.
So in your tax planning meetings, when you're talking to your CPA, make sure that they're aware of any place you're doing business, any place that there is any property or any employees. And the fancy word for that is nexus, right? That means you have to file there.
Yes. It's not the Google phone. That's different. That's a different nexus. So I want to kind of open the floor for any questions that you may have for us, whether it be on year-end accounting, or if you have some other kind of tax questions that may come up.